What's up, investors? Today we will speak about dividends, starting the presentation soon, waiting for people to join. Share screen, movies, share, start. Okay, let's do it. 2 minutes and we begin. What's up? What's up, Travis? Looks like just you and me today. Okay, well, I guess I'll no need to restart. It's been just like 2 minutes. Didn't waste a lot of time because the Zoom of recording and stuff. I guess we'll have enough time. So basically, let's see if Diego joins later and we can continue now. Continue, begin, whatever. Let me just open my presentation. Where is it? Where's the presentation? 11. Okay. So yeah, today we are talking about them dividends. I like dividends. Dividends are one of the best things. This is literally like just, I don't know, free money. Like literally, like people don't call them free money. People don't call them passive income. Like for me, it's as passive, as free as it gets. Like literally, yes, I know that in order to receive dividends, you need to basically pay for this opportunity to start receiving dividends. I guess you know how dividends work. Basically, you pay the dividend paying stock, and every single quarter, every single month, every single year, you just basically receive money for staying invested. And that's all there is to it. So basically, like there's nothing easier than this. Like I do nothing, I'm getting like 30, 40, $50 per month. I'm reinvesting all this money back. They just keep growing. Like it's basically gets like compound interest working even faster, even sooner. Everything is good. Everyone is happy. So that's why they're one of the best things. So, and now opening the presentation, starting sharing the screen. Where is photos? Now this. And okay, so yes, like I said, today is once again fundamental analysis, dividend policy ratios. I think it's the last topic on fundamental analysis. After this, there will be like some like a red flags in investing, something like this. I don't remember. Like I have topics written in my Word document, but I think no. The next one will be activity ratios. So yeah, we have at least one more topic on fundamental analysis. But after this, it's all basically like investment red flags, investing for beginners once again, how to maintain your portfolio, how to do portfolio rebalancing, like all this kind of stuff, how to track your investments. Maybe we'll talk about this, and basically anything else, whatever you might want to talk about in the future, just let me know, and obviously we'll talk about this. But yeah, like I said, I think I have maybe at least topics for another couple of months easily. And then we'll see how it goes. Okay, so yes, if you've seen already that I sent in the group chat, these are basically quick topics to discuss today. What are dividends policy ratios? And the ones which I'm using mainly, and one of the most important ones, it's the dividend yield, obviously, payout ratio, retention ratio, sustainable growth rate. Very rarely I see sustainable growth rate, but I think it's a very, very cool ratio, especially if you're investing in like growth companies. I know that growth companies not paying that much dividends usually, frequently, but sometimes it is possible to, it is pretty interesting, it is pretty useful, I mean, to look at the what's the sustainable growth rate of this company in accordance to its dividends. And obviously you'll see how it works a little bit later. And in the end, if there's any questions, I'll be answering them, obviously, as always. And if there are any questions in between the sections, you know the drill, you know the rules. Every single time I switch between the slides, I see if there are any questions, if there are any more people joining, and basically I allow people, even though I don't know, I made possible so you can enter the room without me allowing you to enter. I have no idea, but still I need to accept the people in the room for some reason. I don't know, whatever. And yeah, let's do it. Let's see if Diego joined or anyone else joined. No Diego, still just two of us. So basically, let's do it. So first of all, obviously, what are dividends policy ratios? Those are the ratios that use dividends as a part of their formula. This is, I think, as easy as it gets. Like basically, you analyze a company based on the dividends that it's paying. Simple as that. And obviously, it's only applicable to dividend-paying companies. Dividend-paying companies. If the company is not paying dividends, like that's it, you cannot analyze it. You cannot see what's the dividend yield of the company because it does not pay dividends. So if the company is not paying dividends, you can basically ignore every single ratio that we're going to be talking about here. But since I'm value dividend investor with a little bit of growth companies and a little bit of the companies in distress in my portfolio, these are still one of the most important ratios that I personally use. Okay. And in order to see if the company is paying dividends, you can simply go like online, Google, Finance, Yahoo, Wall Street Journal, whatever. Like there's plenty of information. You can either just type in the Google name of the company, for example, I don't know, Apple, okay? And just type in Google Apple dividends. And then if it shows you on the official website of Apple Investors Relations section, if it will show you like what are the quarterly dividends, blah, blah, blah. If they talk about the dividends, yes, this company pays dividends. But the easiest way is just go basically to Yahoo Finance, go to select the company you want to analyze or see if they're paying dividends, go to statistics tab, and that's it. In the bottom, it will be payout ratio, dividend yield, and as long as these are numbers, not like 0 or NAs or whatever, it means that the company is paying dividends, and simple as that. but it might not be the most reliable source of information, because if the company is cutting its dividends, or if the company is completely reducing, or removing dividends, completely suspending dividends. For example, it was like this in the beginning of the year for Carnival and Southwest Airlines. As soon as those companies removed completely their dividends for obvious reasons, Yahoo Finance, it took maybe at least, I would say, 1 month or even more to reflect the changes. So Carnival and Southwest were not paying dividends anymore at this point, but Finance Yahoo was still showing that they pay dividends. And because the stock price of these companies literally fell like 80, I don't know, 90%, it was showing like 20% payout dividend yield. It was just mind blowing. I can only imagine that some people might be investing Carnival. They think like, oh, 20% dividend yield, I'll invest in this. And we will talk about why it's so bad to invest in high dividend yield companies later. And I think I did one of the posts about this on Instagram. And I even did a video on my YouTube about why high dividend yield is bad. But here, just in case if you haven't seen those videos or Instagram posts, I'll briefly talk about this as well. Okay, and the way companies handle their dividends, it can tell you a lot of things about the company. In fact, dividend is such a small thing. It's literally like, I don't know, like $1 per every $100 invested, that's a dividend. And because of this $1, because of the way how they treat it, how they handle it, how they distribute it, how they retain it if they're not paying it, it can tell you literally pretty much good amount of things about the financial direction, financial health of the company. And like I was saying already, many of those ratios you will already find pre-calculated by financial websites. For example, we have 4 ratios for today: dividend yield, payout ratio, retention ratio, and sustainable growth rate. And first 3 of those ratios, they are already calculated on Yahoo Finance. So you don't even need to know how to basically find them. Okay, let's see if Diego joined. If there are any questions. No Diego, no questions. We shall continue as always, non-stop. Okay, dividend yield is the first and the most, I would say, like 100%, the most highly used, the most famous, the most useful ratio related to dividends for any single dividend paying company. And this basically shows you how much company pays in dividends in relationship to your investments. And the formula is annual dividends per share divided by current share price. Already by this, you can tell that because it uses current share price in its formula, you can already see that dividend yield is a variable number, meaning that it goes up and down dozens, hundreds of times, even every single day. It's you cannot just go on Finance Yahoo, see dividend yield, and okay, like I assume that if I invest this will be my basically dividend. No, this dividend yield is always different. It will be different tomorrow, 1 week from now, months from now. It is always different. So you need to be very cautious about investing in companies basically just relying on its dividend yield and like, okay, it's high dividend yield, I'll invest in this company. And what it basically means in very basic form, which is 50-50 true. Dividend yield of 5% means that for every $100 invested, you will get $5 in annual dividends. Yes, this is technically correct, but not entirely correct. Yes, if you invest at this very moment, because once again, Finance Yahoo also takes time to update those like dividend yields or anything like this. I'm not sure. I think they update it like once per day or maybe even less than this. So maybe more than this. I don't know. I'm not keeping track of companies every single hour or anything like this. So long story short, yes, if at this very moment when you are investing money, if this very moment dividend yield is 5% and you invest $100 and the share price is exactly $100, yes, you will get $5 in dividends, basically, technically. But it's not always the case, because first of all, like share prices are not always $100. Let's start with the most obvious basic things. Not all the share prices are exactly $100. Sometimes the share price can be higher than this, and unless your broker offers fractional shares, you will not be able to invest $100 or anything like close than this. So in this case, yes, dividend yield will be same percentage, but it will be like a little bit more complicated to calculate. Second thing is that you should always treat how much dividends you will receive not by dividend yield, because like I said, it's the variable number. Every single day it changes. You should treat how much dividends you're going to receive by the actual amount of dividends that the companies are paying per share. For example, I don't remember exactly how much, let's say so Caterpillar or like Apple, once again. Okay, let's take Apple as an example. And I think it is paying 52 cents per share, if I'm not mistaken, 52 cents per share, something like this. Yes. Or maybe it was before the split, but I think there was something 52 cents related, okay? 52 cents per quarter, which was like $1.08 per year, if I'm not mistaken, but once again, we'll just use it for simplicity purposes, $1.08. Okay, so you know that Apple pays $1.08 per share in annual dividends, and you are buying, let's say so, 4 shares. That's it. You will receive 4 times $1.08. You will receive $4.32. That's it. You should not care about what's the dividend yield or anything like this, because company pays dividends whatever basically they declare. The company declares dividends, and unless they cut them suddenly or unless they basically remove them completely unexpectedly, this is the amount of money that you will guaranteed receive. You just need to take how many shares you bought and multiply it by dividends per share. Simple as that. Do not even care about dividend yield. Well, like I said in the example 5 minutes ago, Carnival had like 20% dividend yield, while in fact the company completely removed dividends 1 month even before it removed the dividends 1 month before, but Finance Yahoo was still showing dividend yield of 20%. So it's, like I said, it's 50-50. It's technically correct, but you should never trust dividend yield completely. So it's like very, very tricky. Always be cautious. And the easiest way is, like I said, just to see how much dividends a company pays per share. And that's it. Multiplied by the amount of shares you are planning to buy. That's it. This is your amount of dividends that you will be receiving every single year. And basically, whenever they increase dividends, you'll be receiving more. Whenever you're decreasing dividends, you're receiving less. Simple as that. It's as easy as it gets. And this is what I'm talking about right now. Lower share price means higher dividend yield, because formula is annual dividends per share divided by current share price. Let's say so annual dividend is $5 and share price right now is $100. Because annual dividend, quarterly dividend, it stays the same. As long as the company is not experiencing extreme financial problems, the dividend will most likely stay the same. So the dividend stays the same, $5. The share price at this very moment is $100. 5 divided by 100 is 5% dividend yield. But tomorrow something bad came out, like bad report or whatever it is, I don't know, and the share price became $50. So basically now instead of 100, it's 50, but the dividend is the same $5. So you take $5 and divide it by 50 this time, dividend yield is 10%. That's it. Same dividend, but dividend yield is twice higher now. And basically this is like why you should not take dividend yield too much into consideration while making your final investment decision. Even though it can be attractive to invest in the companies with high dividend yield, you might be thinking, wow, like I'll be getting 10% dividends back, like so cool. And this is besides like 10% the stock market growth, like annual growth rate. So I'll be making like 20% back on my investments. No, it's very, very speculative way of thinking like this. It's very, very wrong way of thinking like this. If the dividend yield is extremely high, it means that the share price is extremely low. And the share price is extremely low happens one of the most obvious reasons, one of the most popular reasons why share price is extremely low is because something bad happened. Like share prices do not go down 20, 30, 40% in one day just because. There's always a very, very bad reason behind such big decline. And so basically, if the share price declines so bad, it means something bad happened. And it most likely means that unless a company is a dividend aristocrat or dividend king, and unless this company doesn't want to lose this status, one of the first things that they will implement in order to save some money, even before firing people, they will reduce or completely remove dividends, entirely remove dividends. So you see high dividend yield, be aware that maybe the company will completely cut the dividends. So imagine this situation: you are investing in a company with high dividend yield, and your only guess, your only wish from this investment is to get high dividends. And you end up investing in the company this, and eventually this company cuts dividends. So now you're stuck with bad shares, and now you're stuck with the company that's not even paying dividends, all because you're so tempted by high dividend yield. Okay, ooh, dividends, that's how much I love them. No joining, no chats. So
Some of the oil companies have been doing that.
once again, what? Let me, did you say something? I think I heard.
Yeah, like some of the oil companies have been doing really high dividends lately.
Basically, yes, like oil companies, like company, and I think there will be that, yes, there will be a little bit later about why some companies pay higher dividends, why some companies pay lower dividends. We will talk about this, and the idea why companies like oil companies, airline companies, cruise line companies, restaurants, whatever, like how it's called, hotels, they are one of the first ones to completely remove their dividends for obvious reasons, because they are not getting basically any profit at all, and they started saving money, started saving some cash for these uncertain times. And the first thing that got cut, the first thing that where they started saving money is by removing completely dividends. So yes, and now, yes, now we will talk about payout ratio, and you will see why some companies pay more dividends, some companies pay less dividends. Okay. So payout ratio, my second favorite. The formula is total dividends divided by net income. The company, any company pays dividends from its net income. For this reason, dividends are not always guaranteed. They can be promised, but they are never guaranteed. Like, yes, they can declare dividends, they can talk about all they want about the dividends, but these are the money that comes from net income. And net income is the amount of money that basically, that's it, after all the expenses are paid, the company keeps for itself, and as a reward, it might give some of its net income to its shareholders. So it's not something that they must give it to you. It's just their voluntary, basically, thank you, voluntary way of like being gracious, being gratitude, feeling gracious, whatever it is, yes, to its shareholders, to its investors. So for this reason, they can cut and reduce dividends easily, like it's not even a big deal, unless once again you're dividend aristocrat or dividend king and you're afraid to lose the status. Then this can be absolutely easily cut. And so if payout ratio is 40%, it means that company pays 40% of its net income as dividends. Payout ratio higher than 80% is dangerous. Like literally, it means that almost everything that they make, almost every single dollar of net income that they have after quarter, after annual report or whatever, after year past or anything, almost 80% of its net income company pays as dividends. Yes. And now why some companies pay more, some companies pay less dividends. You will see very, very little dividends in technological related companies, in innovative companies, in like biotechnology companies, in like biodiesel companies, like those companies that have a lot of potential in the future. And because of this, they always need to keep doing research and development, like marketing, all these kind of things, because these companies, technological related companies, innovative related companies, they need this money to reinvest back in themselves. They need to use this money in order to basically in order to stay competitive. Like, for example, I don't know, Apple pays dividends, and like a decent amount of dividends for a technological company. They pay something like 1% dividend yield approximately. I'm not sure 100%, but it's kind of decent for this sector. And because they have so much money, but they always reinvest back their money in research and development, marketing. You see these ads everywhere, like research and development. Every single phone they claim it's like, this is new, this is new. Like it might be right, it might be wrong, it might be true, it might be a lie, whatever. Like, yes, but at least they always say that they're always reinvesting money, always researching and developing new technologies, new stuff, like new chips. Like yesterday they announced the new MacBooks on their new chips, M1, I guess, or something like this. Yes. So they use this money that's are after net income, after they are using this money that's net income in order basically to advance even further. And whatever is left, whatever other portion is left, yes, they're paying as dividends to its investors. For this reason, such companies, they will have lower payout ratios, sometimes like 20, 30%, like pretty low payout ratios. But if the companies like utilities, I don't know, not industrials, but basic materials like steel companies, I don't know, like wood companies, yes, especially like once again, utilities, those companies, they do not have anything to develop, to research. Like they just provide gas into the homes, they just provide electricity, like that's it. Like they have their power plant, that's it. Like literally they just need to pay salaries, they just need to pay like expenses, and like they don't need to research and develop they don't need to research and develop stuff at least as much as technological companies. For this reason, yes, they can afford paying higher than normal dividends, like 60, 70, maybe even 80% or anything like this. For this reason, it is acceptable. And some companies like AT&T, like dividend aristocrats and dividend kings, those are the companies that have been paying and increasing dividends for 25 and 50 years respectively. Those companies, it is acceptable for them to see higher than usual payout ratio because these companies, they don't want to lose the status of dividend aristocrat, of dividend kings. Lots of people, they invest in those companies just because for them it's a very safe company and they just want dividends from their investments. There are even ETFs for dividend aristocrats and dividend kings. And if one company loses its dividend aristocrat status, it basically means that lots of people will just sell their shares of this company because this was maybe the only reason why they invested in this company, because there were dividend aristocrats. Or ETFs will sell those companies from their portfolio because, like, in order for them to keep track of all dividend aristocrats, and if one dividend aristocrat left the list, they just have no other option than just to remove the same company from their list, selling millions of shares of this company and making the price decline even more. So for this reason, dividend aristocrats and dividend kings, it is okay to see a little bit higher or even higher than average payout ratios, as long as these payout ratios are not consistently high. So if you see AT&T, for example, perfect example, one of the most favorite dividend aristocrat, almost every single investor, like dividend yield is like around 7%. And so this company's payout ratio is even more than 100% right now. But they just if the payout ratio is more than 100%, it means that the company takes additional debt just to continue paying dividends. And the reason they're doing this is to keep this status, because imagine AT&T is one of the most famous dividend aristocrat. If AT&T loses its status, I'm almost sure it will lose the like 50% in one day, the stock price. So many people invest in AT&T just because of its 7% dividend yield and because of its dividend aristocrat status, because it's been paying dividends for, if I'm not mistaken, 36 consecutive years and increasing dividends for every single year for 36 years. If this company loses its status, that's it. There is no, like, literally the company is normal, it's average. There is nothing wow, there is nothing extraordinary about this company. So many people keep it just because of its dividend. For this reason, it's okay to see such companies having higher than usual payout ratio, sometimes even more than 100%. And if a payout ratio is very low, probably this company is saving cash for some future projects. For example, if normally you would see that this company, like utilities, for example, normally the payout ratio for this company is like 70%. But now for 2 consecutive quarters, let's say so, the payout ratio is like 40%. Maybe this company is planning like mergers, acquisitions. So for this reason, they obviously need to save some cash, like in order to acquire some company, in order to merge with another company, or maybe they have a big project coming. Maybe like if this is utilities company, maybe they're planning to build a new power plant or something like this, okay? So for this reason, if you see that the payout ratio is very low, like than it usually is, maybe they're planning to do some projects in the future, whether it's announced or not announced yet. And you can basically go on from this, keep this idea in your mind and decide whatever you want to do with this company, invest in it. Maybe there will be some mind-blowing project in the future. Maybe remove this company from your portfolio. Maybe it will be some very bad acquisition, or it all depends. That's how basically investing works. You have the data, you analyze it yourself, you make your own conclusions, and you make your investment decisions based on your own conclusions. Long story short. Okay, love dividends. Okay. No people in chat. Okay, I got some SCHD. Sounds familiar. It's not Schwab, but it is. It is Schwab. Yes, dividend equity. Yes. It's Schwab. Yes, it's good. Basically, yes. If you are, for example, if I am to assemble my portfolio using just ETFs, I would probably buy like this one innovative ARK innovative ETF, the one that I bought basically last week. I'll buy just this ETF. I'll buy maybe S&P 500 ETF. I'll buy one ETF of developing companies, and I'll buy one high dividend yield ETF. So I'll be having four ETFs. So I will have basically S&P 500, developing companies, innovations for the future, and high dividend yield. So I think this will be my perfect portfolio if I have just ETFs. Yes, perfect. 4 ETFs, I think that's more than enough, because a lot of ETF, it means that some companies will be you'll be cross investing in some companies. Like even with these 4 portfolios, some of the companies will be the same. Obviously, there is no reason for you to invest in Apple in your 4 different ETFs, have Apple in all of them. So for this reason, there's not a good idea to have a lot of ETFs, but I think 4 is more than enough. Yes. They even have a website for this. Perfect. Okay, so I'll open it so I don't forget it, and I'll take a look at this after because we have time limits and stuff. Perfect. Okay, next one is, I'm still sharing if I'm not mistaken. Next one is retention ratio, and the retention ratio is the exactly opposite from payout ratio. Basically, it's self-explanatory even from the name of this ratio, retention ratio. The formula is retained earnings divided by net income, or just 100% minus payout ratio. I did a mistake here, but okay. So or 100% minus payout ratio from the previous slide. It is exactly the opposite to payout ratio. For example, if the company's payout ratio is 60%, it means that this company pays 60% of its net income as dividends. And retention ratio is 100% minus 60, which is 40, which means, like, as you can already guess, that you have net income, 60% of it goes as dividends in payout ratio, and 40% does not go in dividends. The company keeps 40% of its net income to itself, and this 40% is the retention ratio. As simple as that. Extremely simple. So this is high for tech companies, once again, because tech companies, biotech companies, innovative companies, they retain lots of money in order to basically keep growing, keep developing, keep researching, keep doing marketing and stuff like this. And retention ratio is low for utilities because they pay big chunks of their net income as dividends, so they don't retain almost anything. And if the company has high retention ratio, but it doesn't grow, it is bad. For example, company, I don't know, like let's say so, technological company. Okay, perfect example. You would expect technological company to grow like fast because like that's it. They always come up. They're always supposed at least to come up with something new. They're supposed to innovate, always supposed to develop new products. So they're supposedly supposed to grow all the time. So for this reason, you would most likely see high retention ratio. But if you see that the company keeps lots of money in itself, the company retains lots of its money, but it doesn't grow, it means that the company is not using the money efficiently. Maybe it would be better if this company will be paying dividends. For example, you don't want to see Apple keeping like 90% of its net income and growing like 5% per year. Like this is ridiculous. Like companies save so much money and doesn't pay lots of dividends and not growing at all. So very, very like not good basically investment. So basically that's one of the reasons how much dividend related ratios can tell you about a company. Okay. Let's see, doesn't show how much time is left. So I think at least 10 more minutes we have. And if I'm not mistaken, that's the last one. Sustainable growth rate. I haven't seen any single person talking about this yet, even though it's pretty interesting formula. It is pretty interesting ratio. Like you will see basically. The formula is return on equity multiplied by a retention ratio. Maybe it might not make sense while you just look at this just like this, like so what, like return on equity, retention ratio, whatever it is. But it definitely makes sense once you go in deep, like once you start understanding how this formula works, what do these things mean and everything like this. So return on equity, if I'm not mistaken, from the previous week presentation, it was, I think in the previous one, it is a return on equity. This is basically shareholders' net income divided by shareholders' equity. And it shows how much money company makes using basically investors' money. Okay, so if return on equity is like 5%, it means for every single $100 of shareholders' equity, of shareholders' money, company just made $5 of net income. And retention ratio, it shows how much money company that was supposedly to be paid back to its shareholders, company decides to keep in itself. And retention, I forgot how it's recorded on the balance sheet, but it is retention assets, something like this. I don't remember. Yes, retention. So the retention money is recorded on balance sheet as well. And it is also recorded under shareholders' equity, because this retention is technically, supposedly it's our dividends, but that have not became English, but that have not became dividends. So technically this net income that's not paid as dividends, technically it is considered to be still shareholders' equity. Just that instead of getting those money from investors, company kept this money that was supposed to go to investors. It's kind of the same thing. Like, for example, you have $100, okay? You spend $50, so now you have $50 left. Or for example, you have $50 and you decided not to spend $50. So I don't know, you still have $50. It doesn't make sense, obviously, but in both examples, you have $50 left. So spending money and not spending money also in some way means earning money, like you keep the money. So for this reason, now I know how it's called. So retention ratio, it's called retained earnings. On the balance sheet under shareholders' equity, it is called as retained earnings. And so basically you take return on equity multiplied by retention ratio, which is retained earnings basically. And by doing so, you will see how company can grow using basically just these retained earnings, just by using the money that it's saved. It shows maximum potential growth rate that a company can achieve without taking on additional debt. So basically, company can grow using shareholders' equity. Company can borrow money from the banks. Company can raise the capital by issuing corporate bonds, something like this, okay? Like many different ways, or using its cash reserves, whatever, yes? And one of the ways they can basically have net income, distribute some of it as dividends, keep the rest as retained earnings, and then they will use these retained earnings to keep growing. And then you simply take this retained earnings, multiply it by how efficiently they are using their equity, which is return on equity, and you will see how much a company can grow using just these retained earnings. Maybe it will be complicated to understand. Hopefully I explain it kind of understandable, kind of easy, like just in case you have always time for questions. I don't know, I hope we still have time for this, or you can watch this video after I upload it on YouTube, but it definitely very, very cool ratio that's very little people use it, maybe because it's kind of complicated. And sustainable growth rate of 5%, for example, it's also in percentage. It means that a company can safely grow at 5% per year. So you'll get, for example, return on equity 10%, okay, and retention ratio is 50%. So 10% of 50% is 5%. It means that company can use its retained earnings, and by using just retained earnings, it can safely grow at least 5% per year. And if you see that the company grows more than 5% per year, it means that company using retained earnings efficiently. It means that the company pays low dividends for a reason. But if you see that sustainable growth rate is 5%, but company grows just 2% per year, it means that the company should have better paid more dividends because it kept this money, used them to grow, but as a result, they did not even grow as fast as the minimum growth rate that was supposed to grow. So it will be better if the company just paid dividends instead. So if you see sustainable growth rate is higher than actual growth rate of the company and dividends are low at the same time, it means company just should pay more dividends. Otherwise, it's not a good investment. So at the same time, then you go see at the dividend paying history, if you see that the company increases dividends consistently, so you might give this company a chance. But if the company is growing below its sustainable growth rate and pays low dividends, the company uses its equity very inefficiently. This is how much just small dividends can tell you, as you can see. And extremely high growth rates are very hard to maintain, obviously. So if you calculate and you see sustainable growth rate like 30 or 40%, it might happen 1 year, maximum 2 years, but it's very, very hard to maintain 40% growth rate every single year. So always be careful about extremely high sustainable growth. Rates, okay. For some reason, it still doesn't show me how much time is left. So, but definitely it's like 3 minutes left, I guess. So let's see if you have any questions. These are dividends. I love dividends, as you can tell. That's why I'm dividend value investor. So yes, this is how it is. Lost my voice a little bit. Definitely they're awesome. So many things you can tell just by the way looking at the way companies pay those dividends or they keep their dividends. Like you just saw it, like they're extremely awesome. They're so cool. Okay. So yes. Stopped sharing. Don't know how much time is left, just in case if I'm suddenly disconnected, you know the reason.
Hey, thank you, Artem.
Yes, always. For the horde.
That's right. That's right. Always. Hey, man, appreciate it. I'm glad to be back online.
Yes, like how is it going? Everything is more or less good now. You got light and all the.
It's my first day working from home again.
Good, perfect.
Yeah, it's
back
nice.
to normal.
Yeah, I was spending a lot of money like out working from coffee shops and stuff. So
I can imagine because of food and drinks or because of okay.
Both. So it's nice to be at home, save some money, and put that back in investing.
Perfect. That's how it's supposed to be done.
Yep. All right. Well, my friend, have a good one. We'll chat soon. All right.
See you next week. Good luck.
Yes. Take care, sir. Appreciate you.
Thank you for joining. See you next time.
Yes.